Warren Buffett is almost universally accepted as the greatest investor in history. Dating back decades, he's answered nearly every question out there, ranging from religion to insurance. Following hundreds of interviews, conferences, statements, and calls, you would have a really hard time finding something he hasn't talked about, especially in the sphere of finance and investing. But there is one thing that stands out, one stone that seems to be left unturned, and it's residential real estate. Despite the fact that over the past 3 years, homes have become one of the most important and popular talking points in finance, both Charlie Munger and Warren Buffett have been seemingly silent about this sector. While dozens of respected experts warn of a bubble that is set to implode in the coming years following the post-2020 boom, which saw prices rise by over 50%, Warren has never commented and rarely answers questions regarding this topic. But there is something to this. If you dig long enough, you will find the answer, and what Warren actually thinks will undoubtedly shock you. Following hours of research and viewing hundreds of clips, I have finally found the answer we were all looking for. But before I show you, you need to start with some background. After the significant real estate crash of 2007, during which the average home price plummeted by over 28%, a widespread sentiment emerged among the public and investors that real estate was essentially dead. The growth was stagnant and houses were losing their status as a valuable asset class. However, after nearly a decade of sluggish and unremarkable growth, homes began a swift ascent once more. From around 2017, numerous cities across the country experienced a noticeable uptick in property values, reigniting the investor craze. In the pre-2020 era, a significant portion of the general public suddenly developed a keen interest in residential real estate investing. Forums sprang up, TV shows dedicated to the subject aired, and YouTube became flooded with guru house flippers and hackers. The extent of the nation's obsession with real estate can be exemplified by the Our Real Estate Investing subreddit. In 2017, it was merely a small niche community with around 10,000 members, but by the end of 2021, it had explosively grown to over 1 million subscribers. Individuals ranging from construction workers to accountants sought their share of the lucrative opportunities presented by residential real estate investing. Contrary to popular belief, there was a compelling reason for this trend. Homes in the United States were relatively affordable compared to those in the rest of the developed world, and the country possessed one of the world's most advantageous financial instruments, the 30-year fixed-rate mortgage. With low interest rates, surging prices, and ample opportunities for profit, the allure of real estate investing was undeniable. And then came the most unprecedented curveball in the history of capitalism, 2020. Overnight, the entire economy was plunged into uncertainty as it came to a complete standstill. While predictions of a real estate crash spread, the opposite unfolded. Real estate experienced another surge, and in a bid to avert a potential depression, the government drove interest rates to a historic low. From January 2019 to January 2021, the average 30-year rate in the United States plummeted from 4.45% to an astonishing 2.65%. To grasp the significance, consider this simple example. The monthly payment for a $500,000 house in today's market with rates around 7.2% is approximately $3,100. The same house with a 2.65% rate costs $2,000 per month, effectively a 40% reduction in price when viewed through the lens of monthly payments. Now, at this point in the video, you're probably wondering, where is Warren Buffett? Rest assured, we'll be hearing from him shortly. However, before we delve into his shocking insights, let's swiftly wrap up this background story. Following the post-2020 developments, the real estate market underwent a transformation akin to being put on steroids. Home prices surged to a level that left everyone astonished. From January 2020 to the present day, the Case-Shiller Index, essentially the industry standard for measuring average home prices in the country, witnessed a staggering 47% increase. Houses resembled penny stocks, seemingly with no ceiling to their ascent. Those fortunate enough to make purchases during this period witnessed a substantial increase in their paper net worth. In contrast, those who delayed experienced further hardship, as prices which initially seemed unmanageable continued to soar beyond expectations. Even in the current scenario, with rates significantly exceeding recent averages, there is little relief and minimal hope for the average American attempting to enter the housing market. For many potential buyers, beginners, the question is straightforward. Is home ownership still a worthwhile investment, and should we continue to consider it a financial asset? With the median payment now hovering around $2,500 a month, there appears to be only one direction for prices to go, and that's down. So who better to consult on this matter than Warren Buffett? Unfortunately though, when you look into Warren's investment history, quotes, talks, videos, books, and life stories, there's not much info about regular houses. However, I've managed to piece together a few clips that, in my opinion, shed light on his philosophy regarding the American housing market, and the results may shock you. The first clip is from an interview back in 2012, and in my opinion, his response to this specific question forms the bedrock of his entire ideology on this topic. Take a listen.
If I had a way of buying a couple 100,000 single-family homes and had a way of managing, the management is enormous. It was really a problem because they're one by one. They're not like apartment houses. So, but I would load up on them, and I would take mortgages out at very, very low rates. But if anybody is thinking about buying homes, 5 years ago they couldn't buy them fast enough because they thought they were going to go up, and now they don't buy them because they think they're going to go down, and interest rates are far lower. It's a way, in effect, to short the dollar, because you can take a 30-year mortgage, and if it turns out your interest rate's too high next week, you refinance lower, and if it turns out it's too low, the other guy's stuck with it for 30 years. So it's a very attractive asset class now.
If you are a young individual investor at home and you have your choice between buying your first home or investing in stocks, where would you tell someone is the better bet?
If I thought I was going to live, if I knew where I was going to want to live the next 5 or 10 years, I would buy a home and I'd finance it with a 30-year mortgage, and it's a terrific deal. And if I was an investor that was a handy type, which I'm not, and I could buy a couple of them at distressed prices and find renters, I think that's, and again, take a 30-year mortgage. It's a leveraged way of owning a very cheap asset now, and no, I think that's probably as an attractive an investment as you can make.
So as you just saw there, Warren was actually very positive about housing during this entire interaction, saying he'd buy up a couple 100,000 single-family homes if it were practical to do so. Now, playing devil's advocate, you'd say of course he would say that in 2012 when the market had just crashed and homes were practically at all-time lows, inflation adjusted. At the time of the interview, the Vegas Case-Shiller was at 89. Today, nearly 12 years later, it's at 284, representing a 219% increase. You have to ask yourself, would Warren be saying the same thing today with this price escalation in mind? Throughout recent history, it's pretty much been confirmed that investing in American homes is a proven path to riches with a huge asterisk. And I can pretty much prove this with a simple example. You see, because the US is one of the few places in the world you can get a 30-year fixed-rate mortgage, the situation is very unique. Regular people having access to the greatest leveraged instrument in the history of finance makes homes an attractive investment opportunity for the vast majority of people, and here is exactly why. Imagine you're the most unfortunate real estate investor in the world. Now picture this, you already own a home and you're venturing into real estate as a commodity, intending to buy another property for renting out. Let's transport ourselves to the summer of 2006 and you decide to invest in one of the world's most inflated markets, Las Vegas. Back then, Vegas had experienced a surge in prices. Now, with the benefit of hindsight and the knowledge of what unfolded in the following years, we realized that investing precisely at this time would be a worst-case scenario. It's crucial to note that this area was among the hardest hit in the US, so opting to invest here would be considered one of the poorest decisions you can make. Now, to reinforce my argument, let's consider a scenario where you rented out this home starting in the summer of 2006, one of the worst times to invest ever. I acknowledge that certain assumptions were made in this calculation. While it was challenging to find precise rent prices for Vegas in 06, I did find various sources indicating an average rent of around $900. To be conservative, I assumed that a nice 3-bedroom home valued at $315,000 at the time could be rented out for at least $1,250. Feel free to share your thoughts in the comments if you disagree, but I aimed for a fair estimate. In addition to rent, I factored in maintenance costs, closing costs, and a 5% vacancy rate to ensure a realistic assessment. The results are quite surprising. Despite purchasing at arguably the worst possible time in modern economic history and in one of the least favorable locations in the US, a real estate investor who hypothetically rented out this Vegas home would have still earned a 26% cash-on-cash return after all these years. And this assumes that you don't refinance at any point for a lesser rate. That means that even in the worst case scenario, an owner consistently making mortgage payments and avoiding foreclosure would secure at least an honorable return. Moreover, if the owner holds on to the property for an even longer period, the returns would be significantly higher. This scenario essentially proves that if you're a patient, responsible person, it's very hard to lose money in single-family investments. Under most scenarios, this investor in my example would have made significantly more money if they just chose to invest during a more reasonable time or in a less volatile city. And because of the low down payment requirements, you can make a lot of money in this sector while putting down very little. Now, of course, Buffett isn't going to think so highly of this strategy as it simply doesn't work at scale. His business is Berkshire Hathaway, and when you start thinking about purchasing at a scale that would make this worthwhile to him and his partners, this entire strategy goes out the window. Buffett has no interest in the single-family home sector because it's not something that can make him money at a level that he's looking to do. On top of this, there are all sorts of legal issues and public image issues that you would encounter trying to implement a similar strategy at a large corporate level. You can hear him explain exactly this in this next clip.
What do you think of the good old single-family dwelling as an investment these days?
I said a year ago that I thought it was a very good investment for people that knew that they were going to live in that locale for a considerable period of time, found the house they liked, then I told them to take out a very, very long-term mortgage. And I would say the same thing today. It's not quite as attractive as it was a year ago, but it's still an attractive holding, but only if you're going to keep it for a long time.
Now, you may finish listening to this and think to yourself, what am I waiting for? Why doesn't everybody have an investment home and print money? And this is the point where I have to be fair and briefly tell you about the other side of the coin. You see, the reason people like Dave Ramsey, as an example, are against home investment unless you're buying with cash is because at the end of the day, it theoretically introduces financial risk to your life. No matter which way you cut it, when you borrow money from the bank, you are entering a leverage position, and with that comes all sorts of problems and issues if things begin to go bad. While I just showed you how even under the worst external assumptions you can still make money investing, there are dozens of other variables that I didn't go over that could easily wipe you out, especially if you're buying multiple homes and using excessive leverage to establish this strategy. You have to think how many people implementing this are going to go through a divorce, health problems, legal issues, or a job loss that will put their entire strategy at risk. While rare, these risks are out there, and the second a vacancy piles up and your payments run dry is the second a cascading series of bankruptcies overcome your life and ruin your finances to zero. And of course, there are also religious reasons that Dave cites, including the infamous Proverbs verse, "The rich rule over the poor and the borrower is slave to the lender." These verses are grounded in the fact that whenever you introduce debt, you introduce risk and give potential to a catastrophic situation that can endanger your entire family. Who's right? Nobody knows, and given the fact that so many people say we're at the cusp of another bubble, it's debatable whether home investment is as great as it sounds, but ultimately I hope this video was eye-opening and thought-provoking. Let me know what you think in the comments below. Do you agree with the Dave argument or the Buffett argument? As always, please make sure you hit that like and subscribe button if you enjoyed it.